The following program may contain viewpoints and opinions that do not necessarily reflect those of Radio That Doesn't Suck Incorporated or its employees. Welcome to Real Estate Toronto, the radio show about buying and selling real estate in the Greater Toronto Area, with Ora Ross from the Mulholland Ross Real Estate Team. 30 minutes of hot topics and indispensable advice from experienced professionals that work for you. Now, on with the show. Well, a typical Sunday, kind of cold, kind of a little bit of snow every once in a while.
It's January, but we had our first snowfall last week, like our first real snowfall. And the interesting thing I found was that day we finally had a few inches of snow landing on the ground, I kind of looked around and said, yep, the Toronto real estate spring market has arrived.
So we just went from summer to spring.
We are in our spring market right now.
So what are we talking about today?
Well, we've got a fabulous guest. We have my friend Michael Marini with Dominion Lending. He's a mortgage agent. And, we've got some changes to our mortgages coming up. We touched on it last week. And I thought, let's bring in Michael to tell us a little bit more about the changes, how they might affect people out there. And also, he's got some awesome advice. So, we're always looking for ways to help people either pay off their mortgages faster, smarter, just giving you guys some different ideas that maybe you weren't aware of that Michael's going to share with us.
Cool. All right. Well, stay tuned. You're listening to, of course, realestatetoronto.com radio. It is Sunday, 4 p.m., and you're right here with us on talk-radio.ca.
The music you'll hear on Out of the Blue will be jazz for the most part. No specific styles or genres. Every piece of music is handpicked to deliver quality performances. Out of the Blue can be heard on rtds.ca, live Mondays 1 to 3 p.m., and encore performances Tuesday to Friday, anytime on demand. It's the true spirit of jazz, a touch of everything and then some. Thanks for listening. I'm Larry Green.
Buying or selling a home, condo, or investment property may be one of the largest transactions you'll ever make. It's important to gather as much information as you can, and preferably from experienced, successful professionals. When it comes time to make your move, call the Mulholland Ross Real Estate Team with Keller Williams Real Estate Service at 416-230-8500 or visit www.realestatetoronto.com. Whether you're making your first move or selling your much-loved family home, the Mulholland Ross Team offers over 26 years of real estate sales and service across the GTA. Listen every Sunday at 4 p.m. here on Radio That Doesn't Suck to hear the team share advice and information that will assist you with your personal wealth through real estate. Questions or topics you'd like to see covered? Email info@realestatetoronto.com or call the Mulholland Ross Team at 416-230-8500. I'm Todd Miller, and that is, of course, Ora Ross sitting across from me in the Listen Up studio. And we have a guest joining us via Skype today, which is very cool.
We have Michael Marini from Dominion Lending. Hey, Michael.
Hey, how are you?
Good. How are you?
Excellent.
You loving the mortgage rates these days?
They're still not bad comparatively to historical rates, so I can't complain.
Oh, my gosh. They're crazy. Crazy low. So my first question, Michael, just before we jump into all the real nitty-gritty that we want to have you share with our listeners, can you just tell me quickly, why would somebody come to a mortgage agent, a mortgage broker, someone like yourself, as opposed to just walking into their bank and saying, hey, I need a mortgage?
Lots of people do. Obviously, people trust their banks implicitly. They have all of their money there. But from my standpoint, it's more about who is the bank representing and who am I representing. So when you're going to a bank, they're directly charging you the interest on that mortgage. So are they working in your best interest? If they're giving you the interest rate and it's in their best interest to make more interest, are they working in your best interest? Not to say interest a million times there, but as a mortgage broker, I represent every lender in the market, minus maybe 2 or 3. So I'm looking at the lowest rates in the market for my clients to save them money, because the interest rate that they get, I'm not paid that way. I'm paid on the volume of the mortgage. So it's in my best interest, being self-employed, to take care of my clients and to ensure that they're getting the maximum savings that they can.
Oh, so that's very an interesting point. So by you finding the highest interest rate for your clients doesn't mean you're getting paid more.
No, not at all. It doesn't work that way at all. So the lower the rate, my commission doesn't change.
Right.
The higher the rate, it doesn't change at all.
That's very interesting. I appreciate you sharing that with us, because I know it used to be that people would think, oh, we only use a mortgage broker if we can't get the mortgage at the bank.
Yeah, that would be my first choice. I would go to the bank, and then my bank would say, well,
You're
reason
self-employed
A, reason B,
or whatever, yeah.
So, yeah, we'll give you the mortgage, but we're going to have to charge you more interest. Or no, we can't give you a mortgage, and try somebody else.
Yeah.
But this sounds appealing because, again, they're working for you.
Yeah. And you're just shopping out the best mortgage you can find for somebody.
Yeah, absolutely. And it's all we do. Banks have a host of facilities that they offer people, from investments outside of a mortgage to lines of credits to visas. So mortgages are only one component that they offer. And the people that are representing the bank are very young, typically. They don't necessarily have lots of knowledge in terms of mortgage, let alone even have one themselves.
Right.
The only thing they can discuss is the products that bank offers, where a mortgage broker has a host of products from multiple different lenders. And we have to be professionals and understand all of them. So we need to know one bank versus the other, one credit union versus the other, which makes us able to offer the best savings for a client and tell them about the intricacies of a mortgage.
Right. Which is, I always found that interesting, that mortgage brokers have I believe, more of an obligation than necessarily the bank does.
We do legally, because they're under the Bankers Act. They're not even under the Mortgage Brokers Act. So we have to adhere to stricter policies. And mortgage brokers tried to get banks to follow the same suit with the government, and it didn't happen, because banks, again, they offer multiple products. It's not just mortgages.
Yeah.
So, yeah, there's definitely different regulations that they have to follow.
Okay.
Did not know that.
Yeah. So there you go. So even though your bank is offering you a fabulous rate, you might want to talk to someone like Michael to say, this is my situation.
And this isn't to backhand banks by any means,
No.
But as we were sort of alluding to, a bank isn't necessarily going to do better for you on a rate or a perk within a mortgage unless you ask for it.
Well, and funny enough, too, a lot of times we can beat the bank at their own rate. So we have discretion in terms of our commission. Most times for my realtor partners' clients or my clients, I'll buy the rate down with my commission. So I can use my commission to reduce their rate, and a bank can't. So I can effectively beat the bank's rate within the same bank. So I can offer a mortgage cheaper with a branch than the branch can. And it'll happen. A lot of times the branch will send me the client. I'll do the mortgage for them and send it right back. So I'm not slamming banks at all.
No, they're great.
I have to have partnerships with banks to make the relationship work smoothly for my clients, because if I'm going to hand the client to a bank, I better have a really good relationship with that bank to ensure that whole transaction goes according to plan.
Right. Well, thanks for sharing that. I think that answered a lot of questions for people that they didn't even know they had. Questions
they usually think they're being
they
charged
had.
a fee too, right? Most people have that misconception that brokers charge fees, and they do in certain circumstances.
Sure.
Most cases not.
Yeah. So what did you want to talk with us today? I know there's some changes coming our way next month.
Yeah, there's one particular change coming in February to anybody who's applying for a 5% down payment mortgage or 95% loan to value. So it's being capped now under mortgage insurance to a purchase price of $500,000. So you can only put 5% down up to a purchase price of $500,000, and then once you exceed $500,000, it's 10%.
Okay, so I can't buy that $2 million home for 5% down.
Couldn't for a while.
That's
so
true.
mortgage insurance caps you at $1 million.
At $1 million,
right up to $1 million. There's a bit of a misconception there. So it doesn't mean that if you purchase a property for $600,000 that you need to put 10% down on the whole thing.
Right.
So you can put 5% down up to 500,000, and then it's 10% for anything over.
Okay. So are you finding already people getting concerned about that on your day-to-day calls?
Definitely. I get anybody that I've pre-approved with 5% down that's looking over 500,000 has definitely either sent me an email or called me panicking. But once they understand that it's a minor change,
right?
Yeah, they're usually settled, but still rushing to buy.
Yeah.
So if they pre-qualified for 5%, do they need to get that mortgage in place before that deadline, or will it change after the deadline? Because
they need to purchase before the deadline. After the deadline, they'll have to adhere to the new rules.
Wow.
If they purchase this week and they don't close till March 1st, are they still protected?
They should be fine.
They're fine under the old guidelines. Okay.
Correct,
so when you purchase firm after February 1.
Because we go in and get pre-approved, and we've got, what's that window, 90 days where the mortgage rates are guaranteed and the terms of the mortgage?
120. Yeah, 120 days, yeah.
So then we'd have to make sure we find something and lock in.
But now you've got to buy now. Yeah. So if you're looking for that 5% all the way across, you need to call me today.
Yeah.
Today. Great. So talk to us a little bit about, I know, we wanted to talk a little bit about mortgage insurance and the amortization period on insured mortgages, because I think there's some misconceptions about that as well.
Yeah, in general, most people think you can only get an amortization up to 25 years, which with insured mortgages, so anything typically less than 20% down is what you would call an insured mortgage.
Right.
Your amortization is 25 years maximum. But then if you do a conventional mortgage, you don't have to abide by insurance policies anymore. Banks can make up their own policies, and the amortization can increase to 35 years with some lenders. Most stick to 30.
Right.
Tops.
Yeah.
But in terms of budgets, that makes a massive difference in terms of someone's monthly household budget.
So tell us what an amortization period is.
So the amortization period is the length of time that the mortgage is spread over, and it's the major factor that controls a mortgage payment. Most people think it's the interest rate, which is the second largest factor, but the length of time that you spread a loan over really is what affects the payment the most. So if you have the ability to stretch it over 30 years, your payment is greatly reduced.
Right.
But it doesn't mean that you have to pay a mortgage over 30 years. Every mortgage that you get will have some sort of privilege that allows you to pay more to pay it off quicker. So what the amortization period really represents is your base payment. And then from there, you can increase it.
Worst case scenario.
You got it, yeah. So for budgeting, but for a first-time home buyer or somebody who doesn't plan on living in this first property for 30 years, let alone even 5, yeah, so the amortization period for someone who's in their home for a very short period of time is somewhat irrelevant, because as soon as they sell that property, it's like hitting a reset button on your mortgage. You can renegotiate the terms. It can be anything that you want. So it only really matters on the property that you plan on living in for the rest of your life, and you plan on paying that particular one off.
So just an idea then is for those folks who really need to watch their cash flow, through most of the year, but maybe they get paid a bonus at the end of the year, or maybe monthly they get a little bonus or something. Maybe it doesn't hurt to go a longer amortization if you've got the discipline to take that bonus money or whatever and do those prepayments, take advantage of prepaying your mortgage. So even though you start out at 30 years, at the end of your first year, you might already be at 25.
Exactly. And in fact, to get from a 30-year to a 25-year, really all it takes is one extra mortgage payment per year to achieve that.
Can you just say that one again? Because
really
that's beautiful.
That's magic.
Yeah. So to take your mortgage down from 30 years to 25, all you need to do is pay one extra payment per year.
Wow.
I would say quite a few of us can afford to do that.
Yeah.
Yeah, it's just whether it happens. So that's the effect of an accelerated biweekly payment, which is what most banks tell people to do, but people frequently don't budget for it, because if you're on a biweekly frequency, you get hit with 3 mortgage payments in 2 months out of the year. But the effect of it is one monthly payment per year. So if you just went on a monthly payment, and because you budgeted that way and it was easier, all you need to do to match a biweekly frequency again is to do one extra payment per year.
Awesome. Well, on that one, we're going to cut to a break because we're going to let that one soak in, right?
It's spilling out. There's so much great stuff, but that one was such a simple thing.
That's so simple.
And has such a major impact. But stay tuned. More realestatetoronto.com radio right after the break.
Annoying, frustrating.
Of course, you're referring to me.
Some days, enlightening, engaging.
And now you're referring to yourself.
Most days. Just a few of the words employed to describe our show, The Motts. You'll come up with your own.
Hi, we're the Motts, Paul and Carol.
Inviting you to join us weekdays at 2 on Listen Up Talk Radio at talk-radio.ca. And there's an encore performance with Motts Weekend.
You can check us out at themotts.ca. Here's another word for you.
Oh, I wouldn't go there.
Hi, it's Paul Cavalcante, host of The Vinyl Experience, with a couple of magic numbers for you to remember. This is real simple. Are you ready? Here we go. 9 and 3. Every Sunday at 9 a.m., 3 p.m., 9 p.m., and for good measure, 3 a.m. on Monday. This is all Eastern Time. Your times for The Vinyl Experience.
Welcome back to realestatetoronto.com radio, where we're learning some wonderful tips that are useful to anyone across this great country.
How to get that mortgage paid off faster and for less.
You need to get yourself an agent.
You do.
Not a secret agent, but a mortgage agent.
A mortgage agent. I'm Aura Ross with the Mulholland Ross Group, and we have Michael Marini with Dominion Lending. Michael, how can we contact you if somebody on the show has a question for you? What's the best way to contact you?
Either call directly to my company. Do you want that phone number?
Yep.
So it's 416-534-3476.
Okay.
Or you can contact me directly through my website, michaelmarini.com.
It's MARINI.com. Great.
michaelmarini.com.
Yeah, Michael.
Yeah.
I just thought I'd spell the Marini part. I figured most people might have the Michael down. But if not, you can also call us, and we'll definitely send you over to Michael. So that's great. Okay, so Michael, one of the big questions and the big topics that keep coming back on our show is how does somebody get into this market? As you know, it's gone up so much. We're reporting an almost 10% increase across the GTA year over year. Of course, we know some neighborhoods hit 20%. You know, so how does that first-time buyer buy a house? What ideas do you have that you can share with us?
Well, the minimum down payment is typically 5%. There is a mortgage product called cashback mortgage where you can actually have the down payment given to you, which most people don't end up going for because the rates are higher.
Okay.
But just to touch on that briefly, if anybody wants to know about that, they can definitely contact me.
Okay.
But you're basically in a cashback situation. The bank is giving you the down payment, and it doesn't need to be paid back. So your mortgage would be, in that scenario, 95% of the purchase price. The bank is giving you that money.
Right.
But in return, they're charging you a higher interest rate so they can recoup the down payment they gave you through interest.
Okay, but they got you into the market.
They got you into the market, but it always comes down to, so I spend with every client at least an hour and a half doing budgets, and you have to be able to manage the carrying costs. And when you have a higher interest rate, sometimes the payment is just too much.
Right.
So if
and
you can acquire the 5%. Sorry, go ahead, Aura.
Well, and I would guess you'd have to qualify for that
exactly.
increased amount. Okay.
Yeah, exactly. But with 5% down, that's usually manageable for most people. Mm-hmm. The cost of insurance isn't that bad either, and you can take the down payment from many different facilities. You can take it from an RSP. You could take a loan on an RSP and use the RSPs. Mm-hmm. You could borrow it from family. It can be taken from a line of credit. So, or you can just take it from savings. So whatever way, shape, or form, 5% is not a huge amount of money to get into the market. And the cost of insurance on a 5% down mortgage is 3.6% of the mortgage amount.
Okay.
Now, I just wanted to ask you a question about that, too. I mean, this is great to allow a lot more people to get into the market at that 5%. And obviously, everybody has to qualify to get into the market. But is there any danger about that, about getting, I mean, people, as you said, they have to carry it and they have to be comfortable with it?
Yeah, I'd say the biggest thing that people have to worry about is the length of time that they keep a property and where they buy the property. Because statistically in Canada, first-time home buyers are out of their property in the first 3 years, either because they bought a place that was too small and they grew out of it, or they have moved because of jobs. So, or you'd be the best person to comment on it. If they sold their property inside 3 years, they need enough equity growth to have made money to take the equity out. So the location, I would imagine, would be one of the most important things. But they've got the mortgage insurance is, so the way mortgage insurance is calculated, it's added onto your mortgage. So it's a one-time charge that's built into your mortgage.
Okay, so let's say I buy for $500,000. I've got my 5% down. I've got my $25,000. I've got a $475,000 mortgage. Mm-hmm. And then I'm going to pay an insurance on top of that of what, about $12,000?
So it would be 0.036. I'll tell you right now, it's $17,000, which sounds like a monster amount of money, and it is. But that's tacked on to the $475,000.
Okay.
So
you can pay it off over time. You don't need to come up with that cash in hand.
Right.
It's built into your payment, so it doesn't really change that much because we're amortizing it over 25 years. We're spreading this amount of money over a very long period of time.
So a few dollars a month. Yeah.
Yeah, and when you look at the market itself, 3.6% of the mortgage amount you should be able to recover, at least in the city of Toronto for sure, in the first year. Or again, you could probably comment on that.
Well, for the last 20 years, we have been able to. I'm always careful to say for sure that will happen over and over again. But, just on the flip side, if you buy a house and a year later you didn't go up, maybe it stayed the same, or maybe it even went down a little bit. If your job situation has changed, anything else that would allow you to still make the move up. I did work through a market where people were losing money when they sold. They were not gaining money. They were actually selling for less than what they purchased. And what we found was if they really needed that fourth bedroom because they had that other child or, whatever their situation was, I would explain to them, you're just moving your debt. You're just moving your mortgage from your 3-bedroom to your 4-bedroom. Mm-hmm. So
you are gaining in many respects. You
always
are gaining.
Yeah. You always gain if you're moving up. Yeah. So when we talk about first-time buyers coming to the market, I know the government has some tax credits. Tell us about some of the tax credits that can help people.
Sure. So there is one called the first-time homebuyer tax credit that you can apply for after you've purchased your home. It's you can claim on your taxes up to $5,000 having bought your first home for an eligible property, which is pretty much any property in Canada. And the government will give you 15% of that $5,000 back. So you'll receive $750 credit after purchasing your first home.
Okay.
And you just simply apply on your taxes.
And you know what I would advise everyone to do with that $750?
I know where you're going.
Prepay your mortgage with it, right?
There's your one payment, right?
I was thinking of going to the casino or something. No, you're being all...
Yeah. And are there any other credits right now available to first-time buyers to help them with some of these initial costs going in?
So the land transfer tax, which is huge in Toronto, land transfer tax, and for the municipal, which is Toronto, and then you also have the Ontario provincial. So first-time home buyers are eligible for a $2,000 automatic rebate on the Ontario land transfer tax. And then Toronto, it's a sliding scale policy, but you don't pay up to the purchase price of $400,000. You pay nothing. You start to pay above that, which is very reasonable.
Yeah.
And then even when you just get over $400,000, it's a negligible amount. It's not huge. So it really allows people to get in the market, not having to pay those because their closing costs are much lower.
Right. So if you're buying for that $500, you're getting $2,000 back on your Ontario, and then your Toronto tax, you're only really paying on that $400,000 to $500,000.
Exactly.
Okay.
So that $2,000, how does that come back?
It's automatically applied. So you just don't get charged the $2,000.
Nice. Okay.
It's taken off the top.
Yeah. That's really nice. We've been spending a lot of time talking about, first-time buyers getting into the market. Sometimes it should, buddy up with a friend. If you have a partner that you feel might be your long-term thing. But I know you and I were talking this week, and we were talking about how if two people bought a home and one wasn't a first-time buyer and one was a first-time buyer, you mentioned something about weighting the ownership within the contract. Do I have that correct? Okay.
That's right. Especially for the land transfer tax rebates, but it also affects the RSPs in a different way. So if I purchased with my spouse, let's say, we couldn't be married yet. So if you purchase with somebody who already owned a property and you're married to them, you lose your first-time home buyer privileges altogether.
Okay.
So if they're a common law partner, meaning that you've lived with them for the last 12 months in the house that they own,
Yeah.
you no longer are considered a first-time home buyer.
Okay, so this is important
You don't
for
own that
people
house, though,
to
but
know.
you've lived with them.
You've just lost your
That's right.
opportunity to use your RSPs on that down payment. So
RSPs and the land transfer tax.
So folks out there, take a look at who you're dating and make
Decide if
some
and when.
big decisions. Is this worth it?
Buy a house before you live with them.
So, but if so, then what happens if? So is that just the way it is? But let's say I'm dating somebody. We're not first time, or it's even my friend. Me and my friend are going to go buy a house, but I've owned a house and she has not.
So in terms of that, for the land transfer tax rebates, if you both go on title,
Okay.
joint tenants in common, if you're on title 50% each, so ownership 50%, then you would get 50% of your rebates.
Okay.
Okay, so that's just for the land transfer tax. So the Ontario, you would receive $1,000.
Right.
And on the Toronto land transfer tax, you're exempt up to a purchase price of $200,000.
Right. So 50%. Yeah.
50%.
Okay.
So in the lender's eyes, they don't care what percentage you own versus the other person, as long as two people are on title that are both on the mortgage.
Right.
So from the mortgage side, whoever's on the mortgage has to be on title at whatever percentage.
Right.
So if you could agree on it, if you hadn't owned before and your friend accepted this, you could put yourself on as 99% owner with them at 1%, and you would receive your full rebate.
Right.
You'd receive 99% of the rebates
Okay.
that you're entitled to.
And we could always have an agreement saying, hey, if we sold, we'll split this 50-50.
Off the record.
Okay, we won't go there then, guys. But this, we know a lot of couples are living together, buying places together before they're even common law, before they get married. This is an interesting conversation, because if they do this and they buy a house, and then like we were talking about, and then they decide to get married 2 years from now, well, the Family Law Act kicks in and they're 50-50 anyway.
Exactly. So if they were planning to purchase and get married, they're better off purchasing before they get married, take advantage of the rebates, change the title ownership to 99% to 1, because as soon as they get married, it's essentially 50-50 anyways.
So all you guys dating out there, if you think you're sitting with the one, you see, you can call
Buy
us.
some real estate.
And we can have this conversation. But really, for you guys out there, just even thinking you're going to buy something, whether you're a first-time buyer or a third-time buyer, I have to say Michael Marini's been helping our clients for quite a while. I get rave reviews. And Michael, I know you work hard to watch everybody's wallet. You are saving people money. They don't even know when they walk in and sit down with you that you're watching their budget, and you're watching how can you do this in a way that won't cost them as much as it could?
Definitely, yeah. Well, and I'm sure you experience this too. I find that if I spend the time on the budget with people, they feel way more comfortable in making a purchase. So when you take them out, it should be an easier and a delightful experience for somebody to go buy a home. It's exciting, it's emotional, but they can't pull the trigger if they don't know what the numbers look like, if they don't know what the monthly payment is going to be, and if they don't know what the total cost is out of pocket.
Yeah.
It's really hard to make a decision for hundreds of thousands of dollars for somebody who's never purchased before, because it's catastrophic. It's huge.
Well, you know what I see on the other side is people not purchasing the home that would have made them the most happy over such a small amount, where if they sat with someone like yourself who could show them, listen, by throwing in that one extra payment a year, or by doing this or doing that, we're essentially erasing that differential.
Yeah, definitely.
So,
I find a lot of people are just really afraid of being house poor.
Yeah.
Or what happens when interest rates do double, because they easily could. Like we had one of the best markets in Toronto, and we had rates of 5 to 6%. That was healthy.
That's
and
right.
Now we're at half that. So it's a bit of a scary time, to be honest, because people are getting used to this, and
I know
this isn't the norm.
I know.
Even though for almost a decade it has been the norm. So I guess at what point does it become the norm?
It's becoming normal. Yeah. I think we have to cut to a break, but we'll come right back.
You're listening to RealEstateToronto.com radio.
What's new? Probably I'm boring you, but seeing you is grand.
thankfully there was an instant replay for this show, and that is called the Wonder of a Podcast, because there was so much great information. You're going to want to listen to this one a couple of times over.
Absolutely.
And we make it really easy for you to download it to your device to take it on the subway, bike ride, wherever.
Yep. On SoundCloud.
You got it.
Or if you go to
iTunes.
realestatetoronto.com, click radio, you're going to get access to all our shows now. That's
Cool.
That's going live now. So, Michael, I know one of the biggest questions you get asked, I know I get asked it when I refer you to our clients, and that is, what's his rate? What's his rate? And perhaps, can I ask you, are there any other questions someone should ask a mortgage broker besides what's the best rate?
There's a lot, and because of the number of websites that advertise low rates these days, it's become more prevalent. But it's really the setup of the mortgage. What penalties are you going to be charged? What hidden clauses are there? Are you in a collateral charge mortgage versus a single charge mortgage? But mainly, what is the penalty that you're going to pay if you break the mortgage? Because new ones have arisen this year that are ridiculous. There's a whole bunch of lenders right now that are charging 2.75% of the mortgage balance.
Wow.
If you break the mortgage, and you're getting a lower rate in lieu of that. But they're looking at statistics of people breaking their mortgages, and they're taking those penalties. So
on that idea of, making that extra monthly payment a year, there might be mortgages out there that won't allow those prepayments. Definitely, yeah. There's a lot that don't allow the lump sums or the prepayments. Okay. So we're going to have you back to talk about that, because I see that as being a big deal. I mean, we have low rates, and that's amazing. But I think the one message that people aren't hearing is pay it off as fast as possible because it's low. I mean, take advantage of these low rates. Just locking in and sitting on them is not taking advantage. When we see these rates eventually go to 5 and 6, you know what everybody's going to say is, I should have paid it down when I should have made those extra payments.
Yeah, because that'll have a big impact on quite a few people, myself included.
So. We're going to get it down. So, Michael, can we have you back on the show sometime soon?
Absolutely.
That's great. So if you want to speak to Michael, please call him at 416-534-3476 or go to michaelmarini.com.
Or CA.
Or give us a call, or a Ross with the Mulholland Ross Group at realestatetoronto.com, 416-230-8500. I can send you over to Michael or answer any real estate questions you might have for us.
And we will see you right back here next Sunday at 4 p.m. or on podcast. You can hear us at 11:47 on a Thursday evening if you wish.